And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the Hump Day edition of The Real Investment Show. It is a sleepy morning. So last night was my daughter's graduation. Didn't get home till like 11:30 last night. So, but you know, she got up there, had her honors cords on. You know, the closest daughter ever got to a cord was the umbilical cord. But anyway, she graduated. It's all great. So it was a lot of waiting because she's Roberts, so she's way down the list. So, but it was interesting though because they did go through the top 10 graduates. They had to go to 4 decimal points on their GPA to separate out the top 10, who was number 1 and number 10. So I mean that's how close they were, all 4.88. Somewhere around there. So, right. So, but yeah, I had to get out to 4 decimal points to find who's the valedictorian and salutatorian. So, anyway, a couple of things this morning. This is a tale of the haves and the have-nots. This morning, Target reported earnings, missed expectations, warned on profits, stocks down about 2.5%. They continue just to really, deal with the woes of bad choices previously that they made that drove away a lot of consumers. They still have that trouble still hanging over them as compared to a comparative store like Walmart, who's doing great. So again, choices matter, but they warn that tariffs and slower consumers certainly weighing on their business. Conversely, Lowe's just reported earnings this morning. They're up 2.5%, saying exactly the opposite thing. Business is good, profits are good, everything's fine. So is it really a tale of tariffs weighing on all businesses, or is it tariffs potentially weighing on some businesses, or is tariffs just an excuse right now for companies to say, well, we didn't meet earnings? Because again, it's been very hit and miss about who is reporting earnings. Walmart CEO said, hey, look, tariffs are coming in. Certainly, we're going to have to eat some of the prices. We'll try to pass some of it on. But again, they're still growing their business. Costco's still doing fine as well. So it's a very interesting kind of mix about retailers, in particular about who's getting hit, who's not getting hit. Apparently, consumers are still out buying and shopping and doing what they need to do. And we're going to go through some sectors this morning. Just trying to dig into kind of a look at the economy, about what's actually happening underneath the surface, as to what's going on and where this pain is coming from in terms of kind of these earnings and outlooks. Now, again, talking about earnings and outlooks, earnings estimates remain very optimistic. Earnings revisions have now turned back positive in recent weeks, due almost solely to the Mag 7. If you look at earnings revisions, those positive revisions on the whole S&P have come solely from the Mag 7 stocks. They've had a very sharp increase in earnings revisions, positive earnings revisions outlooks. So again, earnings estimates still remain very optimistic here, despite concerns over a debt crisis or the dollar or what the deficit or whatever it is, all these other concerns. Earnings are still doing just fine. And that tells you a lot more about what's happening in the economy overall relative to all these other kind of big headline stories that we kind of warn you not to pay so much attention to, because they'll get you in trouble more often than not. Outside of that, though, like I said, we're going to go through some sectors here this morning. So our Before the Bell is going to be just a little bit longer than normal. But let's get to work here. Here's what you need to know before the bell. Market sectors can tell you a lot about what's happening in the real economy. And again, where money's being spent, because it reflects into earnings. Investors also tend to invest in areas of the markets that are doing very well versus those that aren't. And so, money chasing money tends to give you some indication about concerns over the economy. So lots of concerns lately about it's a recession, we're having all these other issues, it's the debt, blah, blah, blah. Well, let's take a look at some sectors that are very economically sensitive. This is basic materials. Of course, these are your basic companies. This is Caterpillar, this is Deere, this is people out there, building stuff, manufacturing stuff. Money flows have been definitely coming into that sector after, obviously we had this impact from tariffs, concerns over what tariffs were going to do to basic materials, stocks sold off. But since that sell-off, they've been recovering nicely. So again, money flows kind of coming into that. And that wouldn't be the case so much if there was really big concerns about what was happening in kind of that overall space. But communications, now this is, Meta, this is Google, they're kind of in this space. But we've seen a lot of recovery in communication, particularly since that sell-off. Again, concerns over the Mag 7. Where's a lot of money getting spent right now in terms of CapEx? CapEx right now for the Mag 7 stocks, in particular Microsoft, Google, Amazon, those are at all-time highs. Where are they spending their money? They're spending their money on artificial intelligence. That whole story about AI is dead is not really much the case because they're spending a lot of money on CapEx, and CapEx just hit a new record. Now, where are they spending their money? They're spending their money in the technology sector because that's where NVIDIA, AMD, and the companies providing the chips for AI live, along with other AI companies that are building and developing AI. XLK has had a very, very sharp rise here. Now, again, some of that is, XLK is driven by the Mag 7 as well, just like all these other things, but Palantir is up 60% from the lows. Palo Alto Networks has had a big rally here. So companies that are involved in AI, Salesforce, others, those companies also benefiting from the money flows into that AI sector. So that whole thesis about AI was dead just a couple of months ago certainly seems to have turned away. Now look, markets are getting very, very overbought here, and we'll talk about this in this next segment with Danny Ratliff, that we're probably starting a short-term correction here. But again, where have money flows been going? If I want to be an investor, I want to know where other people are investing their capital, and I'm going to kind of chase that capital rather than trying to fight the tide. Areas like utilities also are one of the things that we've talked about previously. Utilities have had a very sharp rise. Now, here's the thing about utilities. This is more right now about AI. Interest rates typically tend to be a negative for utility companies. Utilities are typically very interest rate sensitive, but now we've shifted the narrative of utilities from a defensive income producing asset that basically trades off interest rates is now trading against AI. The need for power generation for AI, etc. Money flows have been going sharply into utility stocks, so those companies have been really helping hedge portfolios as of late. But speaking of interest rate sensitive stuff, then we take a look at XLRE or real estate. Real estate's improved a little bit here, but it's really been under pressure because of the rise in rates. So interest rate sensitive stocks like real estate certainly remain under pressure. But again, real estate hasn't done a whole lot here over the last bit because of this rise of interest rates, but they've been kind of holding water, which is suggesting there's still a lot of money flow coming into the overall market that's helping give it some support. And obviously, since that kind of tariff relief, real estate's recovered kind of with the rest of the market, but not as much as other areas. Another economically sensitive area is transportation. Transportation's been improving as well. Energy also, despite the fact that energy's been coming down here, we've seen some money flows back in energy as well. So this is the energy stock sector. So again, still seeing, kind of some of that concern over economics for certain in areas like energy, which is very economically sensitive to consumers, but we're still seeing improvement. So again, this whole idea of we're on the cusp of a recession, all these bad things are going to happen, the market's really not suggesting that right now. And particularly in areas where there's a lot of money and capital being spent on growth and growth outlooks, utilities, build out, AI, all that, a lot of money flow going in those areas, kind of that industrial, kind of injection into the economy. We're still seeing that. So again, the market's really not telling you much about recession concerns, and it's at least something to pay attention to. But that's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff, talk about, are we on the cusp of a bit of a needed correction here? Pick up with that with Danny Ratliff right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me. Good morning, Danny. How are you?
Hey, morning. Good.
Good.
Tired.
Yeah, me too. I had graduation last night. Didn't get home till late. So this alarm clock came really early this morning. It was like as soon as I lay down, the alarm clock went off. So I was like, what the hell?
Yeah, that was kind of the same way. No graduation, but Michelle had a project that needed to be done before this morning.
Right.
So I got roped in.
Yeah, that happens.
Yep.
So a couple of things we've talked about for the last few days. You know, technically this market's been very, very overbought here. Yesterday the market sold off just a little bit. Again, there's still a lot of buying coming into the markets. As we talked about before, you know, we're going to have a correction of some, and when I say a correction, what I mean by that is just simply prices aren't going up, right? They're going the other direction. That doesn't mean, you know, a 10% correction, a market meltdown, anything like that. So don't extrapolate what I'm saying here into being something that it's not. But, you know, a pullback to the 200-day moving average at least would be a very healthy outcome for the markets. The markets need to have a bit of a break. When markets just, and this weekend's article, I'm talking about trading an unstoppable bull market because, you know, it's just, I'm getting a lot of emails lately. It's like, man, this market just won't quit going up. You know, when's it going to quit going up? It's going to quit going up at some point. It's going to pull back, and then that'll give you a good opportunity to invest some more capital into the markets, remove hedges, add exposure, whatever it is. And this is going to be the defining moment for, you know, a lot of people. Is do they, you know, they've been out of the market. They're trying, you know, have been wanting to get in, looking for that opportunity. When the market pulls back, do they actually take that opportunity? As we talked about a lot before, you know, psychologically, people get caught in the trap. It's like, oh, well, here's the correction. It's going to keep going lower. And then it bounces and goes straight back up and gets to new highs. And again, you know, we talked about earnings revisions. Earnings revisions have turned positive. So that suggests that markets are going to make a push towards 6,000, 6,100 this year, right? So, you know, we're going to be back towards all-time highs at some point this year based on earnings revisions. So we'll see. I mean, it doesn't mean it has to happen, right? But
the evidence of momentum, the evidence of kind of money flows, those type of things certainly suggest that asset prices want to move higher rather than lower at this point. Now, how do you know if something is not working out that way? Well, that's why understanding a bit about technical analysis, the 200-day, the 50-day, those type of things, those are your levels of support to watch. And if you begin to take those out, then the correction is more than just a pullback, and now we've got to make some other decisions. But this is going to be the challenge that we've got to come up with. Again, markets pulled back a little bit yesterday. Markets are going to be down a little bit this morning as well. So we'll kind of see how things go. Buyers have been very adamant about stepping in to buy stocks as of late. There's not been a lot of concern over markets. Doesn't mean that can't change. But as of right now, this kind of buy the dip mentality has been pretty much heavily infused into the markets. And so every time markets pull back, it used to be, kind of prior to 2020 more than anything else, that when you got pullbacks, we saw retail investors really kind of back off. They were wanting to get out of the markets. They didn't get back in the markets. And now it's been a change in that from this, all those monetary injections, and we really, really kind of amplified the markets as a casino more than anything else since 2020. And now we see this whole FOMO of that fear of missing out of retail investors have really morphed, not from the fear of missing out when stocks are going up, but the fear of missing out on a market bottom. And they've been steadily buying markets during declines. And we saw that heavily, and we talked about this in today's daily market commentary. On Monday, retail investors put $4.3 billion into the markets in the first 3 hours on Monday. So there was a lot of heavy buying Monday morning, which was very interesting to see. Again, and they're not backing off. So any time that the market dips, we've seen buyers step in. We'll see if we see that today. But it's certainly been a change in the mentality, particularly in the last 5 years, of something we haven't seen previously.
What's the divergence? So when you look at sentiment, all these different studies are showing that, consumers don't feel really good, but yet you see data like this, that's $1 billion more than the previous high, right? I mean, they put $1 billion more into the market, and there was no news over the weekend.
Right.
There was nothing to suggest that, hey, this was some spectacular buying opportunity, but yet funds were put to work. So what do you think that's a function of? I mean, is this just that irrational exuberance type of mentality that we're at?
No, I think just over the last, 5 years in particular, it's really been more like the last 15. We've just been training investors that you buy every dip, right? Because every time there was a dip, somebody stepped in and bailed it out. And so now they're expecting that the Federal Reserve is going to step in and start cutting rates at this meeting or the next meeting or whenever they're going to cut rates, or the Fed's going to, start doing QE, whatever it is. But they're now very convinced that whenever the market declines, especially when you get a 19.2% decline, they're like, we need to buy this because the market's going to go back up. And so, kind of from an interesting point is that we've always tried to tell investors, you want to buy you want to buy market corrections, not sell market corrections, right? You don't want to sell out at the bottom and buy at the top. And so now they're doing exactly what we've been begging them to do over the last 20 years. And they're actually starting to buy bottoms, which is very interesting because right now institutions are heavily shorting the markets. So you've got institutions, professional managers, they're shorting the markets, and retail buyers are buying it. So the question is going to be who wins out this game. Does the retail investor run out of money before institutions have to cover their shorts?
Yeah, that's true. So what do you think of this a function of? So you talked about the moving averages. Obviously, we're back above many of them, right? I mean, everything's kind of below. So we have a bit of support.
Yeah, got a lot of support.
Yeah.
Got the support at the 50, the 100, the 20, the 50. They're all below us now. So we crossed all the way back through all of those. The only resistance the market has right now is all-time highs.
Yeah.
So...
But what's going to be the catalyst, do you think, that's going to get us there or potentially even over? Is it just going to be the optimism, people continuing to put money back to work? Or, where's the money coming from?
But that's the other question.
Yeah.
Right. I mean, we talk about how strapped the consumer is, blah, blah, blah. But they're coming up with money from somewhere.
But also, if you think back right after tariffs were announced, you had a 5-6% down day, another 5-6% down day. A lot of margin calls were triggered that Friday, right? Announcement was done on Wednesday.
Yep.
And so just personally, I would have thought that it scared a ton of people to death, especially knowing that we also had margin debt at all-time highs. So were they able to liquidate, to sell something else, to pull money from another area and then go back? I mean, that's what I think.
That's the question.
The
though.
unknown.
Do retail investors run out of money before institutions have to cover their shorts? This is if they can keep pushing up stocks, right?
Yep.
If retail investors can continue to push stocks up higher, eventually all these big short positions on equities are going to have to get covered, and that's just a whole level of buying power. Now, one other thing about this though is that it's not just retail buyers; it's also corporate buyers. So we've had just a huge amount of corporate buybacks that have been jumped. We had a 12% surge in buybacks the week after the tariff lows. So when we had that tariff announcement, the markets hit their bottom. Starting that next day it was like the next 2 days after that, we had a 12% surge. Actually, we were negative 12%. We went to a positive 12% swing in the 4-week rate of change. So you had almost a 30% swing in buybacks right after that bottom in the market. So you had a lot of corporate buybacks coming in along with that retail buyer. So there's been a lot of support for the market.
Yeah. So
and buybacks are still intact right now. So
yeah, but with corporate buybacks, aren't most of these companies, don't they have a program that they're doing so little by little as time goes on?
I don't know what that means.
Well, I mean, a lot of them have a program, so they're not just coming out and just with a big mass influx of cash all at once, typically, right? I mean, there are times when they do that, but a lot of times they're buying a little bit at a time.
Well, the window just reopened. They don't buy during the blackouts.
Yeah.
So the buyback window just opened. So like Apple announced a $100 billion new program in addition to their other program. Google announced their $70 billion on top of their program. So when you look at the 4-week rate of change in buybacks, it's been absolutely phenomenal. It's been huge. So it's been some of the largest on record. This has been just a massive surge in buybacks. So they have definitely, and again, prices were cheaper. So, it made sense to pick up prices of stocks at much lower levels.
Yeah, absolutely. And so at what point do you think they continue that or do you
always? They're gonna keep going. That's how you manufacture earnings, man.
Yeah.
If you got,
look at Apple.
But, well, yeah. I mean, if you take a look at, I've got an article, actually just posted an article last Friday on buybacks on our website, so you go to realinvestmentadvice.com. But if you look at the amount of revenue, when you look at their earnings, right, how much of their earnings comes from actual revenue growth versus how much comes from accounting gimmicks and buybacks. About 75% of the earnings come from buybacks and accounting gimmicks. Only about 25% of their growth actually comes from revenue.
Well, it's been non-existent.
Well, not just Apple, everybody.
Yeah,
across the board. So again, this is how you manufacture earnings, and again, the whole game is to manufacture earnings growth so that you can meet your numbers, so your stock price goes up, so that the corporate stock options that belong to the insiders mature at value.
Yeah,
right there.
Well, we can thank somebody for that when they change how CEOs and executives get paid.
Well, that's what Clinton did, and this is why we have the problem we have now. His whole goal was to cap salaries at $1 million. He didn't count on Wall Street figuring out a way around that.
Yeah, there's always a loophole.
So, all right, quick break. We'll be back. I'm sure Danny's got some topics to get into, so we'll get those right after the break.
Yeah,
Don't go away.
We'll figure it out.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize minimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So there's a whole big food discussion going on in our chat channel right now. Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
The Real Investment Show podcast.
I disagree, because at Slotsky's not only can you get a chocolate chip cookie, you can also get a hot cinnamon roll.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and bun.
But you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just real quick, just to show you what we're talking about, last Friday I published an article on the website discussing buybacks. And the importance of buybacks cannot be overlooked. I've showed you, this chart before, but you can see you can see that during that decline in the markets that we had during the tariff announcements, the markets declined, that 19.2%, and buybacks were basically absent. You had a negative flow of buybacks. This is the 4-week rate of change in buybacks. And so you had this very sharp drop off in buybacks. And that was because the blackout window came to fruition. So as companies were getting ready to announce earnings, they couldn't buy back stocks. So you had this big decline. And what you'll notice is that if you just look back over time, you can see that whenever these buybacks disappear, the market declines. And right now we're in the middle of buyback season. So we've had this huge surge. This is about a week. This data is about a week old now. So, but you've had this big surge in buybacks. Now, the reason for this article is that Fisher Investments wrote this article saying that buybacks are a factor in the markets, but they're not the factor. Really? Because here's the correlation between share repurchases and stock market returns. It's an 84% correlation. So it may not be it may be more than just a factor in the market. It might just be the factor, especially when you're talking about over $1 trillion. This year, we're expecting $1.3 trillion worth of buybacks this year in the markets. You know, that ain't peanuts, as they say. That's a lot of buying power that's coming into the markets. And, of course, as I said before, one more, Brent, it also has a big impact on earnings. This is buybacks versus earnings growth. So when they do buybacks, it reduces the share outstanding. So when you reduce the number of shares outstanding, the earnings per share basically increases. So if I have 2 shares outstanding and I have $1 of earnings, I have 50 cents per share. If I reduce the shares to 1, I have $1 worth of earnings. I didn't create any more earnings, right? But I improved my earnings per share just by reducing the number of shares outstanding. So again, it's not surprising that buybacks are very important. But if you want to read the whole article, we go through a lot of different factors, kind of dismissing this article from Fisher Investments, saying that buybacks they're just a factor. They're not a big factor. Don't worry about it. By the way, buybacks have made up 1%. They've made up 100% of the net purchases of stocks in the market since 2000. So I think it's more than a factor. Anyway, that's a different side story. I get fired up over buybacks.
Tell us about it, Lance.
I just did. So there you go.
Tell us more.
Jamie Dimon warning of stock market complacency as investors kind of keep shaking off bad news. There is some truth to that statement. So Jamie Dimon was talking about yesterday is that he expects earnings to decline. And this is something we've been saying for a while, is that earnings estimates are way, way too optimistic right now. Again, you're expecting... Now, earnings estimates have come down already. I showed you this recently. We did the article on kind of the earnings downgrade. In fact, it was the newsletter 2 weekends ago. And we showed the sharp drop in S&P earnings. But now S&P has actually ratcheted those back up somewhat, right? So they cut them, and then they raised them just in a matter of a couple of weeks. But again, they're going to have to come down a lot more because, you look at the long-term trend growth of where earnings should be relative to the economy. We're about $195 in earnings per share on the S&P. And right now, estimates for 2026 are around $250. So so we're looking at about 12% annualized growth this year for earnings in 2025. Jamie Dimon is saying that earnings growth is probably going to be closer to zero by the time we get to the end of this year. And he's probably not entirely wrong. I don't know if we get to actual zero growth, but earnings estimates are still way too high relative to what is going on in the economy. And in fact, an article I've got coming out this next Friday is talking about personal consumption expenditures and paying attention to that. If you want to know where earnings are going to go, pay attention to personal consumption expenditures, because that's 70% of GDP. That personal consumption expenditures where revenue comes from for companies, that gets translated into earnings. So if you really want to know where earnings are going to be within a given year, there's a very high correlation between PCE and earnings, unsurprisingly. And PCE is slowing. We're seeing the economy come under pressure in terms of spending. Consumers are slowing down, and that's going to bring earnings down. So again, he was talking about in particular that investors are way too complacent right now about the potential risk to the markets, whether it's higher costs from tariffs or whether it's just job layoffs, whatever it is, that there's going to be impacts, and consumers and investors need to be aware of that. And again, we've talked about this before, is that there's an incredible correlation between forward earnings on the S&P and the rate of change in the S&P index. So if those forward earnings estimates start coming down rather sharply, we're going to see the market under some pressure at some point this year, this summer, whenever it happens. But, again, just because we've had a correction and a big rally here, doesn't mean we can't have another correction this year. It is possible to have more than one correction within a year. And again, it's just, not talking about a major crash, just, another 5 or 10% correction to realign forward valuations with earnings estimates wouldn't be surprising later in the summer as we get ready to go to the end of the year.
Yeah, do you think that once we get another quarter under our belts with tariffs, that may give us a little bit better clarity as far as what's happening? I mean, right now you had Walmart discussing, or in their forward guidance, they said, hey, we're likely going to have to pass on a little bit of price increases to consumers, vendors.
Real careful with that statement, because that's not what he said.
No, what did he say?
So when they interviewed the CEO, he said that higher tariffs, we're going to try to pass on some of that to consumers. And that's what all the media ran with because they don't like the president, right?
Yeah.
Want to make him look bad. But he said probably we're going to have to eat most of it.
Well, and he said they're going to work out deals with vendors as well.
Correct. And so, it's no, they're not. They may have to pass on some of it to consumers if they can't. See, and that's the big trick.
Yeah.
I can try to pass on something, but if somebody won't buy it, I can't pass it on.
Correct.
Right. So this is the function of what just Target this morning just announced really bad earnings, and their stock's gonna be down 2.5% this morning. And they're talking about tariffs. So the question is if I'm a Target shopper, which we're not, but if I was, if I go to Target and whatever I want to buy at Target is too pricey, I'm gonna go try to find it somewhere else cheaper. Yeah. And so Walmart says, okay, I'll eat the cost. Target says, I can't eat the cost. Walmart gets the shoppers from Target. So there's going to be part of this that is also going to be from tariffs, is going to be companies jockeying. They'll say, yeah, I can afford to eat those tariffs to attract market share.
Yep.
And that's the one thing that a lot of these economists forget is about consumer choice. We talked about this before, like why tariffs aren't normally inflationary, because they forget about consumer choice. Either I don't buy the product, I buy less of the product, or corporations start eating the cost to get market share, to sell a product cheaper.
Yeah, and at some point, if we get into a full blown out recession, that'll be the case. But you're right. In the interim, you're likely going to see people who are just going to, they're going to shop with their feet. They're going to go from point A to point B. Hey, this is cheaper. So
I don't know what you mean by shopping with my feet, because generally today's shopping with your fingers. I just go.
Yeah, it's true.
I just go from Amazon to eBay, Amazon to eBay or wherever.
Can you even buy stuff on eBay these days? I mean,
yeah.
Without getting,
people still buy stuff on eBay, Danny.
Hey, I don't know. I don't buy a lot of stuff.
PayPal.
Well, I mean, eBay, isn't there like more fraud on eBay, stuff like that?
No.
No? All right, whatever.
No more.
Anytime I see something on eBay, it just seems weird.
When was the last time you actually looked at eBay?
I don't know. Not long ago, I'm sure.
You sure it was eBay and not some site like eMay or maybe,
I'm certain, yes. In fact, it was just this week because the kids were looking at baseball cards. And I was like, it seems shady. You're buying from this guy. Look at who this guy is. Like, something doesn't seem right.
It's called an auction.
Yeah. I don't trust these people.
Danny has a very low threshold for trust.
You mean high?
It's only a publicly traded company. No big deal.
I don't know. Seems fishy to me.
You know who's fishy? Alibaba. That's a fishy company.
Have you ever bought anything from there?
No, I have not. Have you?
No.
Well, if you wouldn't buy from eBay, I'm sure you wouldn't buy from Alibaba either.
I did buy golf clubs like 20 years ago, and I got such a good deal. I would have sworn they're going to come in like a miniature set. And I actually got them. They were real, and checked out. I was like, whoa. Like, that was one where you click the button, you're like, oh, I may never see this money again, but it seems like a really good deal. And
have you ever bought any things off Craigslist?
No. That's like the classifieds. Absolutely not.
Everybody think from a classified ad back in the day?
Back in the day, yeah. I mean, when it was in the paper.
You trusted that?
No, but you can verify people. But you can go visit with somebody, actually see the product, and you're less likely to get shot than you are these days.
This is true.
Yeah, come on. I've got this great thing for you.
If you're in the chat right now, have you ever bought anything off Alibaba? Just let me know. Just yes or no. In English.
What about Temu?
Kids have bought stuff off Temu and Shein.
Really?
Yeah. I mean, yeah, you can buy an entire wardrobe off Shein. Well, before tariffs, you could buy an entire wardrobe off Shein. Like when we took the kids to Greece.
Yeah.
We gave the kids like $20 each. And we said, okay, you can go, buy whatever. They all got on Shein and they bought like entire wardrobes for like $5.
Get out of here.
Yeah, I'm dead serious. It's the cheapest crap ever. I mean, like the jewelry makes your fingers turn green, but you know, it's cheap.
Clothes don't make it. They're unraveling as you walk.
Exactly. All right. Nobody's ever bought anything off Alibaba according to our chat. Oh, no, we have one guy, Brian. He said yes on Alibaba, and of course he's been scammed 27 times since then. But other than that, all right, quick break. Be right back. Wrap up the show. Don't go away.
daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just getting ready to wrap things up. So one of the interesting things that I was reading an article this morning is that, there's this lot of talk about how this money is going to transfer from boomers to their kids, right? And there was an actual article out this morning. It was interesting. It says, no, that's not a true statement because the money's going to pass from the boomers to the wives, and that women are in line to inherit like $50 trillion over the course of the next 15 to 20 years. It'll eventually go to the kids after the wife dies, right? But this is going to be kind of the interesting thing. So, this kind of brings up this whole idea of succession planning and kind of getting, things in order, because we've seen very high profile individuals pass away and they don't have a will, they don't have an estate. And I was just reading another article where this very wealthy husband and wife, they pass away, and only about $70,000 wound up with the kids because the rest went to estate taxes, solving estate problems, everything else, because there was no will, everything was in the contest, etc. So I'm trying to get Danny to pay attention here. So he'll pick up on this conversation.
I'm listening.
Well, you're over busy typing over there, so.
Hey, man, somebody's got to be in the chat. So there's a significant problem right now from an estate planning perspective, in that people don't take care of it, right? I mean, as we talk about this often, that people in general, we don't like to face mortality. We don't like to face the difficult conversations, and even when we do, most people get stuck. I can't tell you how many people actually finally took the big leap to visit with somebody, yet they can't even figure out the basics, right? Well, who's going to take care of the kids? And I get it. It's not a easy to answer question, right? And there's a lot of potential turmoil between family dynamics that you create by having to make some of these decisions. But it is something that is certainly necessary, right? I know we all think we're going to live forever, but unfortunately we just don't. And if we all knew our expiration date, all of these life decisions, especially financially, would be that much easier. But this is something that needs to be addressed and needs to be, sit down, actually follow through with it, get it done. Because, it's always amazing when you do see these high profile people that pass, and have done nothing. Like, who's been advising them? What have they been doing?
Right.
First of all, I want to know how are they investing? Because I guarantee you it's probably not like they should be if you can't even take care of the basics. And if you call in to our firm and you request a meeting and you visit with an advisor and you actually get into, besides kind of what we do, and you start to become a client, you will see all of our advisors, it is a very big topic of conversation. What does your estate plan look like? Let's start talking about taxes. Let's get into the weeds of this. And because those are things many times that I can argue you need to have those ducks in a row well before you need to be concentrating on other things.
Right. And of course, the other thing too is for individuals moving into retirement, it's not just a function of the planning part, but it's also the function of creating income in retirement. One of the big challenges that's actually getting resolved, everybody's, fretting over higher interest rates. It's like, oh my gosh, the bond yield's at 4.5% or 5%. Okay. First of all, bond yields were 4.5% and 5% back in 2008, 2009, previous to that. I mean, we're just getting back to more normal levels in the economy anyway in terms of rates, but that's actually great for retirees because now for the first time in a decade and a half, you can actually buy bonds in your portfolio and generate income and, create an income stream off your assets to live in retirement. Because one of the big challenges is going to be twofold, is creating income in retirement, but also not creating so much income in retirement that it impairs your Social Security.
Yeah.
Right. Which is the subject of. I'm trying, Danny.
You're trying to set me up here.
I am. You have a retirement income workshop coming up.
We do. So June 14th in the Woodlands at
Good
the
Lord,
Hyatt
you can
Centric.
lead a horse to water.
Good night.
Just goes to prove it.
Hey, do you want me to communicate with people?
I know. I want you to pay attention to the show.
I mean, it's hard to listen to you, Lance, some days. I mean, I got to do it all day long. Look, you guys have to do it for an hour. This is nonstop. It's like, okay, here goes Lance again. No, we do have retirement income workshop. So it's something Richard and I have done for years. We've tweaked it. Richard's done a lot of updates for, what do you do right now, especially with rates that are a little bit higher, a lot of different options for retirement income. And, that seems to be one of the bigger questions, especially if you've owned bonds. And that's always been a very big component of what a lot of people have used for income. And now that rates have, stayed up quite a bit, where do you go from here? What are the options that you can do? How do you diversify that retirement income? I'm sure you guys get on social media and you see that all wealthy individuals have at least X amount of income sources. And, there's some truth to that, but you need to know how to use this. There's good, bad, and to all of these different types of investments, what works well for you. And don't get too far over your skis in the sense of, I see a lot of times people try to recreate the wheel and they think that, I need to do this, I need to do that. And sometimes you don't. You just make life a little bit more difficult for yourself. And so, and that even goes back to the estate planning purposes of, how liquid are some of these investments? What can you do? What is the, how do you add beneficiaries to them? So we're going to go into quite a bit of detail. This is an actual live in-person event. So if you are in the Houston area, this will be on the north side of town at the Woodlands Hyatt Centric. Saturday, June 14th, 9 a.m., no cost, just an opportunity. There's nothing to, we don't have any product. We're just literally talking about this stuff, answering any questions you guys may have. So you can go to riaadvisors.com, go to the events tab, sign up right there. Actually, I think there's a banner there now. Is that correct, Brent?
Yes.
Awesome. Good,
Yep.
good. After the show, check it out. But yeah,
and actually, if you go to our website, realinvestmentadvice.com, click on the events tab, you can register online right now. So the link is up for that. And importantly, it is in person only. We will not be recording it. There will be no post video airing of it after the fact. It is in person only. So if you want to come, it's at the Woodlands and it's in person only. So just
this is no steak dinner. I get clients that ask, even my dad asks me all the time, like, I get all these mailers in the mail. How come you guys don't do steak dinners? It's like, we're not really just out there selling stuff, It's more our expertise in what we do. And so, this is educational in nature. If you want to get an opportunity to meet some of the team, they'll be there. Great opportunity to meet some of these guys in person. You may hear on the show or just get a better feel for what we do and how we do it. But we'll be there to answer lots of questions. We'll spend a couple hours going over this. So don't hesitate to sign up.
Yep.
Always good getting in front of people face to face. But yeah, there's so many different caveats when it comes to income planning, estate planning, and we were talking about how all these people that have built all this wealth, and yet they haven't put their ducks in a row, and they don't address these specific needs that really, it's just a little bit of time. And for you guys out there, if you're listening to the show, you obviously have a focus on, growing your wealth, trying to find opportunities out there in the market. You're concerned about what's going on. And yet there's so many people out there that you don't protect that wealth. And so if that's you, don't hesitate. Go find a good estate attorney. Go make sure you go actually put your thoughts down on paper. The beautiful thing about this is that you can control funds beyond the grave if you want to, but you also want to protect them to make sure that you keep more money in your pocket. The money goes where you intend it to, and the wealth you've accumulated over the years, you can protect it from Uncle Sam, from getting tied up in probate for years. There's so many different things that you can do to set yourself and your family up. And if you want to create some generational wealth, you're not doing it without visiting with somebody who's an estate planner, and we are not, but we do deal with them quite often.
Yeah. And kind of my plan is I'm going to convert everything I have into cash, have it put in the coffin with me, and then have my wife bury me secretly somewhere in the country, and then have my kids try to find me.
You're going to be a scavenger hunt?
With no clues. If you find it, you can get the money.
I don't know why. I kind of want to manage it just to see what they do. My oldest daughter would probably kill the other three. So she would just eliminate the competition right up front. She has no sympathy for anybody. So I don't know what happened. It's weird.
Her personal motto is the best rescue is a self-rescue. That if you ever ask her, it's like when you're sitting in when you sit in the airplane, and they go, can you and you're in the exit row, and the stewardess says, can you handle that door? And she says, yeah, I'll be the first one out. Best rescue is a self-rescue. Door will be open though.
So she's not one that runs from that seat, right?
Oh,
she wants it.
She's all in it. She's ready to go. But if you're, it's like put your mask on before you put one on anybody else. She's like, screw you. You're on your own. My mask.
Oh, that's great.
Yeah. She's that way. Anyway.
Well, she'd be one who will probably make it through whatever may come.
Oh, yeah. She won't have a problem. It was interesting. There was an article out this morning about, to Gen Z, everything is a recession indicator. And, this is just, they're looking at, anything that goes up in price, whatever it is, eggs, whatever. Now everything's a recession indicator to that age group. And so they're just, they're like, oh, recession's coming. It's like, what are we going to do? And it's like, you're like 5. You've got your entire life ahead of you. A recession's not going to kill you.
No, it's so funny because the kids, I noticed, like even my son, I was talking about baseball cards. He's like, Dad, were baseball cards always this expensive? And I'm like, well, they actually used to hold some value. Now they're just getting you when you go buy a pack, right? Like I remember we had a magazine back in the day when I was young. You could look up the price, this is trading for this now. Now they just go online. That's, we're talking about all the different sites. And he's like, this one's $5 over here. I'm like, yeah, but that's like a $40 card. Something's off, right?
Right.
But yeah, it's funny because I'm hearing that from a 10-year-old.
Yeah, exactly. All right, that wraps up the show for today. Thanks so much. Be back tomorrow with Michael Leibowitz. We'll talk about rates. We'll talk about the big, beautiful bill, what's going on with that, the SALT deduction, what that all means. We'll cover all that tomorrow with Michael Leibowitz. And when will the Fed cut rates next? That's going to be the big question. So that's coming up tomorrow with Michael Leibowitz. We'll see you then. Meantime, get by the website. That article on buybacks is on the website. Our daily market commentary is out this morning on the retail buyers. It's all there for you. RealInvestmentAdvice.com. Also on Substack, at Lance Roberts on Substack. It's all posted there for you as well. See you tomorrow.